Welcome to today's webinar. We're going to be discussing how to build a trading strategy. I would like to welcome everybody that's new and welcome everybody back that's joined me for other webinars in the past. As usual, we will start with the risk disclaimer and then we'll go into the body of it. So take your time to read this. I think that's long enough. Right, so what are we going to discuss today? Actually, we're going to try and cover a lot of stuff in a very short amount of time. So let's get to it. First, I'll introduce myself a little bit for the new people, who I am, what I've done, how I got here. Then we'll discuss trading strategy versus technique. There's a lot of confusion usually in this, so I'm going to run that through. Then we'll talk about the concept of a trading strategy. So how to build it, where do we set it up, different levels on the concept of your trading strategy. And then I'm going to help you step by step how to formulate the foundation on which your strategy builds. And then we're actually going to build the strategy. Right, I'll give you an example how you basically go through the process of building your strategy. And as always, at the end of the webinar, we'll open up the floor for Q&A for those that are in the live webinar. Obviously, if you're on YouTube, there won't be the Q&A session, but that's okay. So let's just move on. Introduction, who am I? Well, like I said, I'm Mike Rottink, 36. I'm originally from the Netherlands. I currently live in Greece, married to a wonderful wife with a bundle of joy called a daughter. Other than that, there's not a whole much to me. I studied international business studies in the Netherlands through a Cambridge program. And finances was always fun, but I got a little bored during studies, and I bumbled into something called binary options back in the day, which I thought was a bit gambly, and deviated into what we now know as Forex, or basically self-trading, right? Retail self-trading. Like most of you, at the start, up, down, you get a little, you get a little bit of a feel of success, and then you overstep, and then you lose one account or two accounts, and then eventually, I decided, enough is enough. I need to stop listening to all these gurus because nothing seemed to be working. And I sat down and started kind of digging through what was actually working. Looking at track records, looking at actual, statistical proofs, and from that started formulating my own system, and that worked out for me. Fast forward a few years, got to a point where I could rotate out of retail trading to bring me to what do I do now. So obviously, apart from giving these webinars, I do mentoring in Forex, more of a guiding hand style. I don't believe in, this is what I did, just copy paste that, because like I said, this is what worked for me. It doesn't necessarily mean it is going to work for you. But obviously what I want to do is transition as much of my knowledge as I can to other people's, in order to hope that, they will not undergo the same mistakes I made along their path to hopefully consistent profit. Furthermore, I deviated into the financial services sector, where I'm looking into getting my qualifications as a financial advisor, which is what I'm doing right now, to also look into private equity and venture capital and other overall financial services advice. So that's me in a nutshell. Moving on, let's actually get to it. So trading strategy versus technique. So the reason I wanted to touch on this is because there's usually a little bit of a mix-up, especially in retail trade, people that are new especially. The veterans usually figure it out along the way, but for new people, it tends to bump into a wall where they think they're doing a strategy, but what they're actually using is a technique. So a good example of this would be, I am a day trader, or I am a scalper, or I use swing trading or zigzag or fishnet or whatever it is. That is not a strategy. That's a technique. It's a method of trading. Now, it is a little bit of a hybrid concept because day trading has a few bits and bobs in place, and it's a little bit more complicated in the sense that instead of scalping, which is a type of trade opening and closing, right? It's usually very small time frame, and very small pips. Day trading has a different approach to trading. So there is an essence of strategy in there, but it's not a strategy on its own. It's a technique on its own. And we utilize part of these techniques into our strategy. A strategy is much more complex and it's much more broad. What you need to understand is that when you talk about a strategy, it covers all aspects of your trading. So your rules of engagement, right? So the approach that you have to your trades, what times you trade in, the tools you use, your technical analysis, your fundamental analysis, your indicators, your risk management, your trade macro management, your trade micro management. All these aspects are part of your strategy. And we're going to try and cover as many of them as we can today. So this is a good fundamental concept to understand what the difference is between a strategy and a technique. So now that we understand that, let's look at the concept. So what is the concept? What is the purpose or your goal of a strategy? So there's obviously a whole bunch apart from, hey, I want to, make more money. Sure, but that is a result of your strategy and of your trading, not the goal. So you have a long-term goal that you set in what you work towards. So for example, it could be my goal is to get to enough funds to put that into my private pension, or I want to diversify into structured notes with an investment fund from, I don't know, Goldman or GAM or Pacific or whatever, right? Or I want to start investing into real estate at some point. So I want to rotate out of retail trading into real estate. Generally speaking, Forex retail trade is a stepping stone towards the bigger guys. But it takes time. And I'm not saying you can't just stick with Forex. You can. There's plenty of people that have done that. But Forex has a few pros to it and a few cons to it. And we're not going to get into those today, but obviously when you think about more established, high profile, multi-asset fund investments, they're in general just more stable. And it has to do with capital, right? If you look at risk management, capital determines your possibilities. So putting it in a big pot of a couple million makes it much stronger from a risk management perspective, and thus a result perspective, much more consistent than you trading your own account of 10,000 euros, 1,000 euros, whatever it is. Right. So the goal of the strategy, apart from what you eventually want to get to, and that could be a figure, right? You could start with 1,000. It's like, okay, my goal is in 5 years I want to be at $10,000. Right? And please don't say numbers like I want to be a millionaire by the end of the year. That's I'm not saying it's impossible, but that's not trading, that's gambling. The other part of the goal is that you create consistency in your trading. And there's a very important part about this, because what consistency does, whether it is consistently bad or consistently good, that doesn't matter. You can alter your strategy if you're consistently doing the same approach to every trade. And that makes sense, because if your trade is different of approach and different of strategy on every single trade, you cannot possibly identify what you're not doing right, because you have no consistency to back test on. This trade went wrong because reason X. That trade went wrong because of reason Y. This trade went wrong because of reason Z. They're not correlated, but all of them went wrong in some way or another. But if you consistently approach your trades in the same way using a strategy, then you're going to build up a track record that you can back test and backtrack, allowing you to identify issues in your trading and your strong points in your current strategy. And then you adjust it and you file it and you fine tune it until you get to a point where the issues are so minute compared to your yearly return that you're on track to your target at a suitable and risk appetite acceptable level. Right? So that is the goal of your strategy, to be consistent. And I say this in all my webinars. When you think about retail trading, the big difference between people that do this for multiple years, that do it for 10 years or more, right, like me, the reason we can keep doing that is because we have a consistency to how and what we do. Yes, you could luckily get a jackpot here or a jackpot there, but those backfire more often than they profit. The guys that are consistently, yes, I'm not having huge spikes. Well, occasionally you get lucky, obviously, but yeah, you don't have these huge spikes normally. But in time, I just outpace you, and I stay in the game, and I don't lose my account. We all know from certain social media traders, let's say, where you see they're doing amazing for a year, and then the second year, and then the third year, boom, they blow up the account, like all of it. Just 2 years of profit down the drain. And this is because the risk and the approach is not a consistent one. It's literally just grab whatever you can as fast as you can. This is not something that's going to work, because if you stretch this out in a 10-year, 20-year time span, which is what the actual realistic investment period would be, let's say 10 years, the chances of something going wrong in those 10 years is pretty damn high. But if you do a little bit more calculated, more steady, and more consistent, you can fine tune along the way. You can slowly build up momentum, and it will build. Now you're thinking like an investor. So now that we have that part, we have our goal, right? We know what we want to do, and we now understand, like, okay, I can use my strategy to get my results that I know have been initiated in the same way and handled the same way, so I can backtrack and see where exactly are my weaknesses and where are my strengths. Which brings us to the core structure, or the foundation of your trade. The core and the foundation we're going to get back to in the next section. But the core structure, here's where we start to implement, for instance, our risk management. So what's your risk appetite? For those that don't understand what I mean by that, is how much percentage of capital are you risking per trade? That should not be a variable. That should be, well, it shouldn't be a variable in the sense that there should be 2 or 3 scenarios, which is the rules that we're going to get back to in the foundation, that determine what that risk level is. But there should be a cap, and never more than that. For me, for instance, there's a very simple saying of, you do 5, usually what I do with my trainees is 5, 3, and 1.5 or 2%, depending on what I want. I say you do 5, 3, and 2. So there's different rules to that, to which one is implemented. And it has to do with the strength of the trade, the confidence in the trade, what kind of asset it is, how volatile it's been lately. The reason you do this is that it allows you to automatically assess multiple numbers of trades at the same time, with never having the risk of zeroing out your account, which allows you within your risk management to create diversification. And this doesn't have to be just FX. It doesn't just have to be the majors or the minors or exotics. This can include, for instance, somebody mentioned earlier, the SP 500. You can do stock trading in here. You can implement, commodities. Right now, your capital obviously is going to be determining what you can and can't do. Right? If you have €1,000 or $1,000 account, or whatever currency you have, let's say $1,000, and you have that account, it makes sense that you can't have open 20 different trades on like, gold and iron and corn and cacao and stuff like that. So you need to keep that in mind, but you cannot overstep your boundaries. Like exotics are way more volatile than the majors or the minors for that matter. But obviously, yes, the lot sizes count differently for them. However, you need to understand that if you trade a trade properly, you have a certain breadth of room that you need. Your stop losses are determined by your technical analysis, like I've explained in a past webinar. How you calculate your stop loss and your lot size based on that. And at where it goes, your stop loss is predetermined depending on where you're going into the market. It's not a fixed percentage of pips, right? Don't think that it's good to have, I always trade with a 30 pip stop loss. That is the dumbest thing I've ever seen. Because there's no way 30 pips is always the right amount. It's either too big, way too little. Pips mean nothing. They're a number. I can have 300 pips, right? They can be worth $30 or they can be worth $30,000. It's a number. It's until I put a lot size to it that it gets a value. And this is what we play with, right? Variable lot sizes. So within your core structure, within your risk management, this is a very, very big part of it. Now, keep in mind, diversification of trading is a lot of different things. Obviously, we can't look at every aspect, but when we look at the foundation is a set of rules, and we're going to get back to that in the next slide, right? For now, we're just going to stay here on the concept. Now, obviously, you can also see from my concept that I mentioned technicals and fundamentals. Well, this is very simple, right? You need to understand your technical aspect. It's what technical tools am I going to be using in my trading? It's part of your strategy. All right, so resistance and trend lines. Okay, pretty stage 4. What indicators are you going to be using? Are you going to use oscillators? Are you going to use overlays? Are you going to use both, combination of moving averages? Are you going to be using Fibonacci retracements? Are you going to be using Bollinger Bands? RSI, stochastic, MACD, volume. Like these are all part of your technical analysis that you need to understand. And this is across the board. It doesn't matter what you're trading. It doesn't matter if you're trading FX, if you're trading stock, if you're trading, commodities, it doesn't matter. All of this stays exactly the same. Right? So you have to keep that in mind. So your technicals, obviously I have several webinars on this already. You need to understand what you're going to do with them. And also the balance of technicals versus fundamentals. Fundamentals, obviously you need to understand, at least to a certain degree, what the fundamental drivers are and where they're headed. Do not confuse fundamental analysis on an economic calendar with fundamental drivers. They're not the same thing. All right. Again, it's too complicated. There's a separate webinar all and so on. But the fundamental drivers is basically the long-term picture. And then you have your news announcements, which is a short burst in between. It's the economic calendar, right? Now, the fundamental drivers basically determine why certain things move in the longer projection of time is what the what the market makers work with. They have a more long-term trade, but we don't have trades that run 6 months. Because at that point, you literally just married your position. Generally speaking, our trades run a week, maybe 2. Sometimes you have like this trade from heaven that lasts for a month that just keeps going. Okay, great. But generally speaking, our trades are like a week. And if you are a short time frame trader, they're going to be much shorter. They're going to be 10 minutes, an hour. Right, most people are day or intraday traders, right? So within the same day or about 48-hour turnaround. So you need to understand what your technicals do that, and then combine that with what fundamentals are with that. So which fundamentals do I look at? Which part of the fundamental announcements do I take into account? Which do I ignore? Understand how they are correlated to, natural hedging and your other positions. All these aspects you need to take into consideration. So let's circle back to foundation. So when you look at formulating a foundation, you need to understand there's different trading time frames, different trading times, right? I've flipped them around in my head. So different trading times and different trading time frames. Again, they're not the same. Trading times is at what time of the day are you going to be trading? Again, this has an impact because the market reacts differently. Let's say you're in Europe. Let's just take them center. Your trading morning is already when the Asian market is past halfway. You just opened, but the American market still needs to open. So there's going to be another spike when that opens because usually they wait for the American market. So, is that the time rate? You're going to trade between European Open and American Open? Are you going to be trading before the European Open opens? Are you going to be trading until a little bit before, but mainly after American opens? And basically Asian closes. Like, this is very important to understand, but mainly for your initiation and your exit strategy. Once the trade runs, if it's an intraday, you're going to go through all the cycles, obviously. You're looking at development. You're looking at micromanagement. Well, that's a different part. This is mainly for the when do you do your analysis that should be fairly consistent. You basically want to write down a schedule for yourself and follow that schedule. Because that way you're going to consistently get the similar type of information with a similar type of market volume, with a similar type of market volatility, depending on announcements. Right? There's some variables there, but again, you try to make it as consistent as humanly possible in this time frame. So then we talk about time frames, and somebody asked earlier before when we were warming up, so what time frame should I trade in? Well, that depends. That is one of the things you have to look at. So when we think about month and week, you should think fundamental drivers. This is long term. You look at a year back, 6 months back, right? How the market develops, where it wants to go. Please don't go back 10 years. Like, there's no reason for that. In the vast majority of cases, the markets back then have nothing to do with the markets now. Levels have shifted, interests have shifted, correlations have shifted. Like, there might be a little bit of a reference here and there that you can use when you're at a historical high or a historical low and you need something, sure. But in general speaking, you look back a year, in a week you look back 6 months, in a day you look back 2 weeks or so, right? And then on an hour you look back, 48 hours, something like that, 48 candles. Because that is the most relevant information for you. That's how the market has been for the last 48 hours. So what time frame am I trading in? Well, it depends on what kind of trading you're going to be doing. If you're going to be scalping, okay, your time frame is going to be a minute. If you're going to be swing trading, you're probably going to do day week. If you're going to be doing day trading or intraday trading, you're most likely going to stick around between a day and an hour, and the 4 hour that's in between there. So this depends on what you want to do. And again, this goes back to what exactly do you think you want to do? What are you comfortable with? And what does your account allow you to do? Swing trading, for instance, requires a lot of down draw room. It's a different approach to trading in that technique where you try to guess the turn of the market, but sometimes you're a week early or 2 weeks early, and you have to write it down. You have to commit to keeping that trade open for a bit to a certain degree, where allowing it to swing. You go in way too early, basically. But you build it up because as it goes down, you open more positions. You need capital to do that. Scalping doesn't require that much capital, but the problem with scalping is you need an intense amount of time because you need to do volume and you need to get it right 90% of the time. Because the way scalping works is you go in and you go out, and you go in at 0, let's say, and you go out at 5 pips profit. But your stop loss is never going to be 5 pips. It's also always going to be 10, 20, 30. Right? Because you need a little bit of wiggle room because you have spread, you have commission, et cetera, et cetera. So you're never going to get back. You need a really, really high win rate for scalping to actually work if you do scalping right, which is extremely time intensive and stressful. And this is why trading robots are usually better to do this, because they just pick up on certain algorithms. But when you think about it, a trading strategy, and that'll start making sense when we start talking about the rules. Trading strategy that you're going to be writing, that you're going to be making for yourself, you're basically writing your own trading algorithm for yourself. It's your own little red book of trading algorithm. That's in essence what you're doing when you're building a trading strategy. Now, a trading robot only has execution and exit orders, right, based on certain variables. Right, it could be a dynamic AI that learns different variables. Okay, all great. But in the core essence, it's just I use this information to determine whether I go in or not, and this information determine if I should go out or not. That's in the essence what a trading robot does. We have a little bit more nuance that we can apply to things. So that covers trading times and trading time frame. The other part, again, is going to be, what are you going to be trading? I mentioned minors, majors and minors and exotics, but yeah, somebody else mentioned, I want to trade the SP 500. Okay, then you need to make sure that your strategy that you're going to develop, that your rules are going to be applicable to CFDs. It'd be the SP 500, it'd be the Nikkei, the FTSE. It doesn't matter which one it is. They all have similar behavior. But again, for instance, for the SP 500, you need to keep in mind, what time frame is it relevant to trade this bastard in? Well, that's going to be more when the American market is open, because it's American companies, right? So you're going to want to adjust your trading times to be when that market is active, right? So you have to keep that in mind. And it can be everything, right? The bigger your account becomes in capital wise, the more you can diversify as per your risk management into different things that you're trading at the same time. This is why when you have professional trading portfolios, and I mean like multi-asset, multi-layered, hedge funds and things like this, they don't trade one thing. They don't even trade 10 of similar things. It is a complete diversification across the board in multiple different asset types and securities, which means that you balance out the risk, because if one market is not doing well, it means another market is benefiting from it again. And what is important to understand there is, like, let me just put an example. Let's say you have a multi-asset fund. One part of the multi-asset fund is very well going to be a Forex, right? Euro, dollar, a little bit of pound stuff in there, the yen probably. Right, so we got a couple of trades of those. Then we got cash trades, probably 20%. Then we're going to do a little bit in, treasuries, a little bit of bonds, because they're pretty stable, but the yield is basically related to inflation and a little bit of the security. So you don't want to, put too much in there because it's not really going anywhere right now. Then you have real estate. Okay, real estate is a good part, but when you have 1,000 euros, you can't do any of this. It's completely out of your league. So this is why your goal should be to rotate into it, because you can understand by diversifying it in that way, the risk of losing money becomes less and less and less. Unfortunately, in this market, the saying is true, money makes money. The more you have, the less risk you're actually taking, because of proper risk management, because of diversification, multi-level risk management. Another part of what you're trading, so I mentioned it in technicals already, is what indicators are you going to be using? right? So you're going to be using triple moving average. Are you going to be using MACD, RSI, stochastic, volume, Bill Williams? I mean, whatever it may be that you want to use, make sure you're consistently using the same ones and have the right settings for them based on what you're trying to trade. Right? They don't have a blanket setting. There's no one setting for everything. Especially with indicators, you're going to have to adjust them a little bit when you're trading stock, when you're trading commodities, or when you're trading FX. They're similar, slightly different, because your viewing time rate is different. Right? Commodities, you don't trade commodities on an hour, right? Gold, there's no point in trading that on an hour. You're technically scalping at that point. You trade gold on a 2-3 week basis, like a month. I'm not saying you can't do it in 48 hours. Of course you can. Of course you can day trade gold. It's just more beneficial to look for long-term trades in things like commodities, right? Gold, oil. And if you think about securities like, stocks, especially the SP 500 and FTSE, yeah, these are very, very good things for day trading and very good, but you need to adjust your time when you trade them to be when that market is open, when it's most volatile. Volatility is not a dangerous thing. It's a little bit of a knife of two edges, but for us traders, volatility is our lifeblood. You need volatility. If the markets aren't moving, you're not making any money. You want volatility. And I know it's scary at first, but you want to find where the volatility is. Volatility means this is where the money is at. So eventually you start chasing the volatility instead of chasing your own tail. Market situations. Okay, so this is another one, and this one is a bit more nuanced. Over time, you're going to get an idea of different market situations, apart from bullish and bearish behavior in different markets, because the euro US dollar has one behavior in a bullish market and another behavior in a bearish market. And that is almost for every single aspect of almost every single security or asset that you can invest in. So few small exceptions, but most have a very distinct pattern in a bullish market and a very distinct pattern of trading and behavior in a bearish market. Identify this before you start trading. Try to understand them. You don't need to be an expert on it, but at least get a concept of like, hey, if it's a bullish market on the euro US dollar, it tends to do this a little bit more. If it's bearish, it tends to do that a little bit more. So I need to adjust my approach on trading and utilize strategy X for the euro US dollar. And this is your set of rules. So let's actually take a look at a set of rules. So when you're building your strategy, you start with the rules, then we get our chart set up, and we get our risk management again, and then you get your back testing. So we're going to go run through this one by one. So let's start with the actual rules. So when you think about it, a trading strategy is an accumulation of multiple layers of rules that is basically a flow chart. And I used to have them on a sticky note on my wall next to me because, well, every time I lost a trade, it was usually because I didn't follow my own rules. Yeah, we're human. So you just put sticky notes on your wall or on your desk or put them on your forehead. I don't care. But try to, as much as you can, follow them. And this is how you would have an example of what that will look like. So let's say the rule number one. Let's identify first whether the market is bullish or bearish relating to the time frame you're in. Obviously, from a fundamental driver aspect is the big one first. So let's say a week. Has it been for a month or more, let's say for the last 6 months, been more of a bullish market or a bearish market? Or did it just flip? Are we like halfway? And look a little bit on, look a little bit left of your chart. What is the behavior? What does it tend to have spikes? Does it tend to grow slowly? Does it tend to be stable? Does it tend to be flipping every other day but still go up? Higher highs, lower lows, or the other way around. Okay. Then I need to decide, before I enter the trade, is this a long trade or a short trade? And I mean this in the sense of a time frame. Am I going to go into this trade? Am I looking for finding a trade that is going to be a long-term trade, so multiple days, a week, 2 weeks? Or am I looking at a trade that I want to do within 24 hours or even less, within an hour? Right? So you can fill this in. Right? So if, let's say your rule could be, if bull, right, then short. If the market is bullish, then I want short-term trades on this specific asset or set of assets, right? Let's say you throw all the euro pairs into one pot, then you have a set of rules for trading euro pairs, and you're going to follow that every single time, right? But you have to determine this for yourself. There's no shortcut. There's no quick way of like, here, copy paste, there you go. That's the strategy. Run with that. There are variables in which it changes. Like I said, if it was like as simple as that, you could write a trading robot and it would work like miracles. Unfortunately, we all know that trading robots tend to not work for the long run. Eventually, they all crash and burn unless you consistently keep changing them and adjusting them. And this is what we do as retail traders manually in our head with our rules. Right? So next thing is, so let's say it's a bull market and we decided we go, what did I say? Short. So we go short on the bull market, short-term time frames. Then the target is going to be at least 0.25% of the average daily rate. And the risk is no more than 0.25 of the average daily rate, depending on where the technical tells us where that is. That means that if my entry point is outside of that range, right? So my entry point is, let's say 1, and I am outside the 0.25 daily rate. I'm at 0.4 of average daily rate where my stop loss should be. That exceeds my rules, ergo I abandon the trade. Now let's say it meets these criteria. It meets bull, short, it meets the target criteria that I want of at least 0.25 of the average daily rate. So let's say the daily rate is 100 pips, which is not much, but let's say 25 pips, which also means 25 pips stop loss. But my take profit is actually 130 pips, which exceeds 0.25 of average daily rate. And my stop loss is, 20 pips, which is 0.2 out of 100, which is the average daily rate, let's say. Right? So we met all that. We meet all the criteria. Okay, great. So now we're going to move on to rule number 2. Oh, in my example, I actually did the other way around. So let's say all that was long. So now, if my moving average, so now I include my technical analysis, I include my indicator. So if my long position has a moving average where the small is smaller than the 250 moving, or the 200, the 100, and the 50 moving average, whatever your settings is. In this example, 250, 150, and 50. Then I proceed. But if it is not that way, then I flip my initial assessment and it becomes a short instead. Right? So can we go back? Yeah. So here we identify is it bullish or bearish. I want to identify if I'm going long or short initially. I want my target and my risk depending on the direction I change. Then I compare that to my indicator. And it says, okay, well, if it's smaller than my 250, 150, 50, I go long. If not, I go short. As long as it meets criteria from rule 1. Hope everybody got that. So then we set number 3. Now let's continue with the long. But I only go long if my indicators indicate it's not overbought yet. If my RSI and MACD don't say it's like, pushed through the roof and it's been climbing for the last 6 days without any retrace, then maybe I should be looking at a short. And that means I revert back to my initial rule and do the whole process again. And if they don't match up, the flow chart doesn't match up, you abandon the trade. And then let's say you go to rule number 4. I will only take this long now if all the previous rules match up to, the moving averages are correct. It's telling me it's not overbought yet. And the trend is actually up and it's at the bottom of the channel of the uptrend. Then I will initiate my long trade. But if it's at the top of the channel in an uptrend, I can go a short. But is it oversold? No, then it's probably not oversold. But my moving averages may not be wrong. So now I have a conflict, which means that things don't line up perfectly, which is going to be an assessment choice now if I want to take an equal amount of capital risk or take a reduced capital risk trade. If I think like, okay, look, I'm in the top of the up channel, which means that it's probably going to pull back, creating the perfect setup for my long trade that I initially was running through, but we're not there yet. So what I'll do is I'll take my short at a 3% risk, and then once it gets to the bottom of the channel, close it and turn it into a long trade and initiate the long trade there with a 5% capital risk. So that way I don't wait for nothing, I at least do something with the potential movement that's there. And this is a lot of fine tuning. This is also a little bit of, it's up to you. Sometimes, especially if you have a small account, don't trade against the trend. You're not beating the market. All right, so this is one thing I want to touch on. If your mindset is going to be, I can beat the market, you've already lost, because you won't. And in reality, it's simply because you're too small to make a difference. We retail traders are along for the ride, nothing else. We don't determine which market flows do. We don't. The only time that happened is, let's say, we all remember the GameStop, shenanigans. Oh, what a laugh everybody had. Oh, look at that. Look at what the retail traders did. Yeah, that was the dumbest thing I've ever seen. The capital behind that, creating a move like that, is A, unjustified, and B, what is going to sustain it? Nobody's keeping their positions. It's going to come crashing straight back down when people cash in on their positions. Like, anybody that went into that, I really wonder what they were thinking. Because a lot of people got screwed over by that because they thought they were, making a lot of money, and then the other day it was zero again. You lost all of it. Right? So don't try to be smarter than the market. Just let the fundamental drivers do their thing. Let the market makers and the big players just run it out. Don't try to beat it. Just go with the flow. We're the bottom feeders. We just nibble along on the way. We take a little scrap and we build ourselves up to eventually join the big race. But never ever have the idea. It's like, everybody, yeah, the market's going up, but I know the market's going to go down because I think so. Even though everything is telling me it's going to keep going up, but I'm going to say it's going to go down. And people say, oh, well, Mike, I've had scenarios where, everybody told me it's going up or down and I took the other direction and did. Okay, fair enough. Now let's compare notes and do that 100 times and then compare who wins more, you or me. Who's the more consistent one? I can guarantee you it's me. I have to guess. Right? Because you're trying to beat the market and it doesn't work. You're literally, people have this mindset that without the strategy, without having that consistency, what happens is that you try to focus on, I had this really big win this one time. Yeah, but you lost like 20 times before. If you would have just had a strategy and consistently followed trend, you would have won the other 9 times, which outweigh the profit you made now of that one time. Right? So this is the mindset you need to have. So let's move forward. So let's look at a chart setup. So let's actually go to a chart. So later. So for instance, price action is also part of your trading strategy. I just covered that. So here we have, for instance, your setup. You have your technical analysis, you have your indicators, you have everything set up. And then you can also identify, price action if that's part of your strategy. You implement your price action. Yeah, does that make sense? But you usually start like this. You start at a week and you just get an idea. What is the market doing? So we don't want to go too far back. You don't want to go back, you don't want to do this and then go like, well, in 2018, we were here. Yeah, I know. But since 2018, the market was basically dropping, and it had nothing to do with Corona. That came much, much later. This is March 2020. This is when things started getting serious with Corona. So let's take a look at what the market has done since then. Well, it's recovered to the point, pre-2018. Okay, great. What is the market recently doing? Well, we have this little thingy, and then basically from within the last 24, we have that. So it's moving towards a point. Oh, look, it's converging. So although it's converging into a same price line, we are looking at probably somewhere in the range. I have a little thing here, so I can't, in this range of 120, 120, 500, right? So now you add all your other layers of technical analysis. So let's, now we go to a day and we have a good, and we know the drop, we know what that happened, from a fundamental aspect and whatever. We had the drop, we had a recovery. Okay, so what is it doing now? Okay, well, it's dropping, it's trying to recover. It doesn't really have the confidence. The market confidence is gone for your US dollar for different reasons. Right? There's uncertainty with the dollar, there's uncertainty with the euro. So all these factors you keep in mind. So let's say you do your technical analysis. No, okay, then you come out to this. All right, so we're here. These lines are from like 6 weeks ago. They're still valid. In the 4 hours, it looks like this. In the 1 hour, it looks like that. Oh, I didn't do hours on this. So on a week, we have all the information we need. Right? It's trying to reset. We already know what it's going to do. So here we can already see like, okay, based on my strategy, if I would go through my rules, this wouldn't give me anything because yeah, the momentum is down very, very much so at the moment. At the same time, in the long term, it wants to converge. So the long term is technically speaking moving sideways between 2 points that are getting smaller and smaller towards each other, which means there's less and less room. It's had a pretty rough last few days where it was a little bit volatile, which means that there's probably going to be some kind of recovery system. So do I still want to short? Yes, but it's probably going to recover up first. Different aspects. So now you go through your rule book, right? But here you would have a stop loss underneath this. Now you need to think to get a proper risk reward ratio, for instance, if your stop loss would indeed be somewhere over here, just make it red. Where's red? Red. Right? So because this is like basically the range, and it doesn't matter if you're trading an hour or not, it's still the same rule. It might be a little bit less, but you should be underneath this, right? Underneath that shadow. So from here, what can we say? Well, we had an engulfing candle, so there's a price action there. And now it's kind of stuck, but we already know why, because we expect it to want to go to 12500, which is basically here, but it's going to bounce up and down between those lines that we earlier saw. So this is your thought process. Analyze what the market is doing and then go like, well, this is probably not the best trade because I can't get a good ratio unless I take a long when it's at the bottom here. Then my risk reward is going to be very low risk, but potential good reward. But it's kind of against the momentum. So rule, we revert, we set up the other rule. Then we obviously compare that to all our indicators. Okay, is it oversold? Yeah, so I don't want to do short now. I do want to do the long because they are showing me there at the bottom, and this shows me at the bottom. So I probably missed my, because the moment was probably here. Okay, so you then also combine it with all price action things that you had here. And like I already mentioned, like here you have the engulfing, then you go to a 4-hour chart, for instance. Okay, so we have like a very, very steady growth after a very big drop, which means only one thing. There is still way more momentum downwards. There's a lot of pressure for it to go down. Otherwise, it would have recovered much faster like it did in March 2020, where it just shot up, shot down, shot back up, and then kind of just started recovering. But here it's a much more slow pace. You can see here, just from the way that it dropped and the way that it's recovering, there's not enough confidence in the market to really push this up. Right, so now in the shorter time frame, we see an opposite. It is overbought. So I don't want to, so depending on what time frame you want to trade in, that's going to be the ruling one. All right, so now you've added, you've put in your technical analysis, you've put in your fundamental analysis, you've put in your rules setup, your step-by-step rules. You've determined on what strategy you're going to be using in the sense of trading technique, right? Your scalping, your swinging, your zigzagging, your naked trading, your fish netting, whatever it may be. And then on top of that, you're now going to think, okay, risk management wise, extra layer on top of it, like we already mentioned, what is my risk percentage? What is my amount of trades at any given time? What amount of capital in total do I want to have open at any given time? When you're in Europe, you can only use 70% of your capital in European brokers before you get margin called. So you should calculate up to 50%, which means that if you do 5%, it's 10 trades at any given time at the same time without any risk of zeroing out the account. And it gives you room to have 10 trades, which means you have a diverse set of trades open. And if you have a small account, let's say $1,000, you won't be able to do that. With a small amount of trades, you're going to have 5 at best, right? Because you won't have the room. And then we get to back testing. Because you're consistently going through your rule book, and not just those 4, you're going to have multiple sets of rules. Right, set number 1, 2, 3, 4 on different aspects. It'd be stock market, it'd be commodities, any security you want, it doesn't matter. But you go through your trades. And what is important is that you then do your back testing. And your back testing is going to very simply be, you look at your trading results, and then you go back, you go through the rules. Did I follow all of your rules or did I oversee something? If I didn't oversee something, where exactly did it go wrong? Was it my entry point decision? Was it my stop loss take profit ratios? Was it my foresight and fundamental development? Or did I just not micromanage my trade correctly? Did I not set up a trailing stop in time? Did I not set, this is all part of your trading strategy, right? So another set of rules is, if you think about it, 3 sets of rules would be everything. If you think about the sets of rules and time frame of the trade, pre-trade, during trade, closing decision / after trade, right? That should be your guidebook. You should have 3 sets of rules for that, right? So before you open the trade, when the trade is running, So your entry point, your trade management during trade, and your exit point risk rule book. And every single step has all the aspects we've discussed tonight. Now, obviously, it's more complicated than this. There's much more we can do to this. However, unfortunately, we don't have the time because every single aspect is very, very set up in itself. Okay. So recap this in your head, run it over, set it down, and really think for yourself, what do I want to achieve? How do I want to get there? What is my risk level that I want to use? What am I going to be trading? When am I going to be trading it? How am I going to be trading it? For how long am I going to be trading it? And how do I approach my entry point? How do I approach my during trade? And how do I approach my exit? And how am I going to verify and backtest my trading? That is encompassing what an actual trading strategy is. All the steps mentioned. Having that said, that brings us to the end of the actual webinar part. I know this one is a little bit more theoretical, and don't worry, for those that are watching on YouTube, there is obviously, you can rewatch this on YouTube. You guys have the recording. I would like to, for the people that are not going to stay for the Q&A, thank you for watching. Thank you for listening. I hope that this was useful to you. I hope you learned something from it. Please keep in mind that at the end of these webinars, they usually send out the survey. It's an anonymous survey, but it would help me if you fill it in just for feedback purposes, right? What do you like about it? What you don't you like about it? Because it helps us adjust. Also it gives you time to give suggestions and everything else, right? So in that sense, thank you for listening and see you next time.